Good afternoon, folks, and welcome to our 2-year anniversary Global Compounders webinar. Everybody at Marcellus is thrilled that we have made it to this benchmark. And actually, it's just yesterday that Arinder migrated to India from the United States, where we left one of the largest family offices in the country to join the team. And then between Arinder and Jaiveer, they built a fine team of analysts. It feels like yesterday, it feels like that just 2 years ago have passed in a blink of an eye. But there are multiple reasons why we at Marcellus are thrilled and delighted at this landmark, not least because all of us, several of us in Marcellus have invested in the product. We've seen financially how it's benefited us. Obviously, if over a course of 2 years, you get a product which compounds at nearly 30% in dollar terms, you can imagine the wealth it creates. And we've benefited from it, especially as the Indian economy enters a cyclical downturn. The benefits of us having part of our wealth in a US dollar portfolio invested in the world's most powerful compounders is evident to us at a very tangible, at a very financial level. Several of us can see the benefits on our statements that we get from Marcellus every month. I think the second reason we are delighted at the success of DCTs, we have long since believed that theoretically that having a dollar portfolio with the world's best companies, and it gives you diversification. The Indian market is the best performer in the world over the last 20 years. But over the last decade, the United States has been the strongest market. And not only are these two the best markets in the world, the correlation between the markets is low. And having two markets which have low correlation gives you powerful diversification in the portfolio. We believed it theoretically, and we believe that benefit should be available to every Indian family. The fact that journey is underway, the portfolio is now raised in excess of 100 crores from Indian families and from NRIs. I think it gives us great satisfaction that something we have done theoretically is now also available at a practical level to Indian families. And the third reason why the success of DCP is a matter of great pride for us is we're learning from the world's best companies. We're learning from the DCP team as Jaiveer and the colleagues in the DCP team, as they show us how the world's best companies are run. It's also rubbing off on our domestic investment portfolio and our domestic investment strategy. I think I wish the DCP team the very best. I think they put in enormous amounts of hard work. It's not a joke to sit in India, to sit in Bangalore, Bombay, Ahmedabad, and research large companies at the other end of the world. They've done a terrific job. And many thanks to them for their stellar efforts. And we wish them every success in the years to come. So I'll hand over to Arindam. Arindam, can you hear me? Sorry, let me hand over to Kulbhushan. Kulbhushan, can you hear me?
Yes, Saurav, I can hear you.
Kulbhushan, could you take it away?
Sure. Thanks, Saurav, for the intro, and a very warm welcome to all the participants who have joined in. Global Compounders PMS completes 2 years for us, and of course, while in broader terms, 2 years seems like a short period, but tremendous challenges have gone through in last 2 years. Whether we look at it from a geopolitical perspective, we saw Russia-Ukraine war. There is the developing Middle East conflict, South China Sea events, right? Elections, wherein investors often would want to see what's the outcome and how it will impact the market. So we saw elections in major European countries. We saw it in India, Taiwan, and more recently in US. In investments, of course, the way technology has started playing a role, there are a lot of disruptions which happen on the technology side, and we saw a few of them playing out in last 2 years. Coming back to the classic economy, crisis event kind of things, there are some regional banks which face acid test in US. China, which has been growth engine for the world for last few years, it saw its trade tensions with US and European countries. At the same point in time, it had its own real estate crisis to deal with. So any of these events and have sizable impact on the way markets function. And when we complete 2 years on Global Compounders, what we see is that it has dealt with all these crises or events in a very practical and very studious way. The outcome has been pleasant for us, and of course, that we'll discuss in detail in today's webinar also. But what we'll also focus on is the process, how one how an investment manager looks at all these things, and what is the way they deal with the investment process, how they fine tune it. So on this call today, we have the investment team for Global Compounders PMS, Arindam Mandal, who is the head of global equities. JB is here with us, who is head of global research. Kumar Mayank is from investment team. Collectively, we all will take you through the discussion today. So Arindam, over to you to just tell us how have you managed to navigate through all these crisis challenges in past 2 years and still have come up with a super performance on GCP.
Thank you, KB, and yeah, you are absolutely right. And to sort of point, 2 years just flew by. Talking about the disruptions or the challenges that you have seen, both in terms of macroeconomic challenges, as you mentioned, I've seen crisis in China, the U.S. regional bank crisis, everything. I mean, last 2 years has been quite eventful, and probably it is always like that. That is why it's a market. Now, that one thing probably had a, I would say, outsized impact on broad market was the high inflation and rise in interest rate. Now, as market is typically forward looking, um, we are kind of lucky per se. I would say that when we launched the product, the market was already kind of pricing in the impact of both of these to some extent. So we kind of launched the fund in October 2022, and the market was kind of down 18-20%, S&P 500 that year. So again, we became lucky to some extent. Having said that, I mean, it has been a very unusual market to start with. As you can see, the red line is basically the S&P 500 since we have launched. So it has compounded at almost 22.5%, 22.3%. Now, if you look at the gray line, this is interesting. The gray line is you take all the stocks in S&P 500, equally weigh them. You don't have to do it the weighing by the market cap. So equal weighted S&P 500, which is kind of more broad-based market, that has compounded just 14.2%. So the large cap pulled the entire market broadly. Now, what has been surprising, and I'll say positively, we have been positively surprised on that side. That despite GCP being more bottom up, looking at companies in the mid to slightly large cap in that kind of zone, still the GCP portfolio actually outperformed significantly the broader market. In fact, if you look at the right hand part of the chart, you might notice one thing that the extreme right is the attribution of the total returns. For example, in these 2 years, the market given total return of around 50%. So out of that, 25%, right? Half of that return has come through this large 7 or 8 stocks that we always hear about. That is your Apple, Amazon, Nvidia, and Teslas of the world. For us, I mean, definitely, as I mentioned in previous webinars, that we are not happy that we missed some of the big ones. But at the same time, the typically the bottom up research has its own challenges. But at the same time, we could identify stocks despite not being part of that cohort. They still did pretty well in that time frame. And as you can see, the max 7 contribution to our portfolio is actually meaningfully lower than what the broader market has been. So most of our return has actually come from stocks which are not probably that popularly known. I mean, it might be known at some circuits, but it is not that common. Now, in the real time, I mean, this is what the portfolio kind of has done since we have launched. Again, 2 years, very short time, but it has been reasonably well performing so far, despite all the broad macro challenges, kind of very polarized market, etc. But still, the portfolio could navigate through those times.
Uh, One question which comes to mind is, what has driven this? In what has been a challenging time for actively managed funds? Where has this outperformance actually come from?
Yeah, that's right. So yeah, so if I go through it, I mean, the broadly, it is I would say it has come from better earnings growth. If I simplify it, so if you think about our portfolio, the compounding of the portfolio stock. So the one way to look at it is you look at the forward earnings CAGR. So what that means is that stock market is always forward looking. So instead of looking at past year, you are trying to look at what is the expected earnings in next year. So in last 2 years, as a cohort, that has compounded around 16 to 17%. Vis-a-vis, if you look at S&P 500, that has been around 9 to 10. So that kind of explains the bulk of the the outperformance that we have seen in the portfolio.
And does this earnings outperformance sort of cleanly translate into stocks, or are there other moving parts there as well?
Yeah, so there are other moving parts as well. Like for example, I mean, there is one part we can definitely talk about is the the portfolio construction part of it, right? So when we look at our largest positions in the portfolio, we'll we can revisit some of the data later, but the largest positions in the portfolio, they have actually done pretty well. And in fact, if you look at the key contributors of the portfolio, I mean all the stocks that you see on the top on the left, they are actually their position size were higher than the average position size in the portfolio. So that has worked well for us. Definitely, there has been some detractors. I mean, the most common ones we know, some of the big ones like Nvidia. But broadly, I would say being in the right stock with, I would say, reasonably right amount of position size, that helped quite a bit too.
Thanks, Arun.
So, one piece here, Arindam, is what worked for the portfolio in all these times? While you have explained some bit of it, if you can just throw some more light on it as to what exactly worked for the portfolio.
Yeah, so I mean, look, I mean, there is one thing I would highlight here is that the stock selection actually worked pretty well. In fact, I was just looking at the best performing stocks in the portfolio. And if you look at all this top five names, TSMC is definitely a big company. I think it's a 800, $900 billion company. So it's a behemoth. But excluding that, if you look at the other four companies, they're kind of in the middle of the pack, right? I mean, somewhere between 50 to $100 billion market cap, some even smaller when you pick them up. So in that sense, the stock selection definitely worked in our favor, and that credit likely goes to what you call the process that you have developed, how you are selecting stocks, right? The kind of fundamental research, the kind of digging that you do for every tiny company that you find. And the second thing is the portfolio positioning that I was kind of highlighting with JB, that if you look at the top 15 companies that we had in our portfolio, so GCP is a concentrated portfolio. So if you can recollect, 15% total top 15 stocks typically has an allocation of 70 to 80% of the portfolio. The rest of the 15 has the tail. Now, if I take those 15 stocks and just see that how they have worked over time, over last 2 years, you would find that there is just probably one stock which is Danaher that didn't really work in our favor, which was a overweight stock on relative basis, but the stock didn't perform. But broadly, other than that, our framework around torque, our framework around business core, analyzing the businesses, that actually I think worked pretty well for us throughout this time frame.
And in the same light, while you did mention some of the things which worked for us, I'm sure in a portfolio not everything goes in one direction. It's good that the bigger weight stocks worked for us, but anything which we missed wherein things could have been better or which hurt the portfolio.
Yeah, so I mean, you might have seen that. I'll ask JB to pitch in here, but if you have seen this thing here, the biggest drag, related drag compared to the market, has been NVIDIA and broadly the semiconductors. We kind of misjudged it. So I'll actually invite JB to talk more about it, how we thought about NVIDIA, because this stock, we actually looked into this stock before launching the fund, but somehow we missed some key elements to it. JB, why don't you give some colors on it?
So we had looked at the entire semiconductor space in late 22. We identified that, okay, this is a cyclical sector, but cross cycle, this sector has healthy growth. The sector also has some very deeply moated companies, which tend to do better than the broader market on a cross cycle basis. Um, this is what helped us identify TSMC and ASML. So one's a foundry, the other is a semiconductor equipment supplier. Both of these have the characteristic of being neutral arms dealers. Um, when we looked at NVIDIA, we saw that, okay, on a cross-cycle basis, it broadly tracks what TSMC does, which puts it ahead of the broader semiconductor market. If you recall, at that time, we were heading into a crypto winter. There was a fair bit of NVIDIA revenue related to that, which was going away. But we saw that would likely get compensated by data center revenue from AI. What we did not anticipate was just how large the AI wave would actually turn out to be. If you look at the chart at the bottom of the screen, right, what has been historically TSMC-like performance has become completely decoupled over the last 2 years, right, and is expected to continue decoupling into the next year. Now, this reset is reflecting a lot of capex that is being invested by cloud companies as well as other hyperscalers, as well as companies from different sectors around the world into setting up AI data centers. Now, the pace with which this capex has emerged and the extent of this capex is something we had not anticipated, and that's in a way that's why we ended up missing NVIDIA. Now, when we're sitting here today, right, with this reset having happened, with this reset being well priced in, the question becomes, once this price has reset, what will be the pace of growth for this data center capex? Right? This is where we're somewhat less confident. We're not sure what sort of ROI will get made on some of these data center investments. And just to give you an example, Microsoft has spent $49 billion of capex over the last 12 months. Now, this is one of the few companies which actually gave an AI revenue number. And what they've indicated is that next quarter, they will hit about a 10 billion annualized AI revenue run rate. Right? This is typically a 40 to 50% operating margin business. So that really doesn't imply a very high amount of ROI on these AI-related capex investments. Right? Till we get comfort on that AI, that ROI getting delivered, we're not willing to extrapolate the current reset into the future and assume that on this base, AI capex will keep growing at the same sort of pace.
Got it. So is it fair to say, JB, that so basically three things broadly changed towards 2021, 22 on that the data center share of the entire capex of semiconductor capex that went up, and NVIDIA's market share within that also went up. And because it went up so much that they gained some pricing, which is typically not seen through a cycle in semiconductor, which where you see this massive spike in the revenue growth of NVIDIA vis-a-vis TSMC.
Yeah, Yeah, I think that's a fair summarization of the reset that's happened in the market.
Got it. And going forward, our assumption is that, as you said, the return on capital being invested in this is going to be a little bit more uncertain. So you want to see the results before putting in more money. From in that standpoint, the growth might be on the higher side of probably have seen the peak growth or close to the peak growth for next year or so. Is that fair?
Yeah, I think that's fair.
Got it. So another stock actually, which again we have been fairly bullish on. In fact, we did a Spotify podcast on that. Is Danaher. Again, multi-decade story of great capital allocation, and we also had a very high allocation on Danaher when we started the portfolio. Uh, that also didn't work out the way we expected. So we have Mayank. Mayank does, he covers Danaher for us. So Mayank, if you can share some light on Danaher, what we liked about the business, what went wrong, and going forward, how should we look at the Danaher business?
All right. Yeah. So yeah, Danaher definitely has kind of underperformed as per our expectations. So one thing we have to understand is that for this company, the period from 2020 till 2022 was really a blockbuster period, where there were several tailwinds that basically benefited the company. So they gained a lot from COVID vaccine development early at the onset of COVID. Then post 2021, because of the supply chain issues, a lot of customers were overbuying products that led to excessive purchase and uh, excessive ordering by these customers. And finally, post COVID, there was also availability of cheap money, and that led to a lot of startups, biotech startups being funded. So the combination of these three factors really helped the company to deliver very strong results during this 3-year time period. Now, we very well understood that this was an over-earning period, and there would be a reset coming in the next few years, as the customers who have basically overbought inventories uh, would digest this excess consumables in manufacturing of drugs and vaccines. What has been the disappointing part is the rate of destocking activity. So that has been slower than our expectation, and that is what has basically negatively impacted the share price performance. Now, if we look at what our expectations are in the future years, so there are definitely positive signs coming in. So first of all, if you look at the destocking activity, which has been the core concern in the short term period, that has almost come to an end. Customers have consumed their excess inventory. They are coming back with new orders, and the company in their most recent earning calls highlighted that their book to bill ratio has come to 1x after being remaining less than 1 times for almost 6 quarters. The second important thing, which is more from a long-term perspective, is the rate of new drug approvals. So if you look at the chart on the top right-hand side, the number of biologics and biosimilar drugs that are being approved by US FDA has been steadily increasing. And 2024 has been a really blockbuster year, in which even in the first 9 months of the year, nearly 29 drugs have been approved, which is the highest in the industry's history. So that is a really positive sign for the long term. And finally, the third aspect, which was the biotech funding, even in that area, the scenario has improved. So if you look at the current run rate of biotech funding, it looks like the overall funding for 2024 would be higher than 2023. So if you look at a combination of these three factors, all of these things should help the company deliver good results in the next year. So that is how we are looking at this company for now.
Got it. So just to give you an idea, I mean, how we thought about this space, we used to also own a company called Sartorius Stadium in the same space. But given what Mayank just explained, that we got an idea that the overstocking uh, might be impactful for relatively lesser sized players or less diversified players, which is Sartorius Trading, we actually exited the stock. But for Danaher, we probably were a little bit more complacent. Having said that, I mean, on the destocking part, as Mayank was mentioning, the pickup didn't happen as per with our expectation. But broadly, I mean, we still are quite positive on the longer term trajectory because biopharma or in general biotech spending is something uh, that is truly bound to happen. It is more of a matter of time. And in that case, you want to play with the neuter arms dealer kind of stock. So, I mean, Danaher kind of perfectly fits that bill.
Uh, Arindam, which brings me to a question that, of course, we have explained the pluses and minuses for the portfolio in last 2 years. Uh, Existing as well as, let's say, if I'm a new investor today, I would also want you to highlight what are the future opportunities available, given at the juncture we are in market today. If I'm, in, if I'm thinking of investing in GCP, where do you see future opportunities for the portfolio?
Look, yeah, absolutely, KB. So we're buying the portfolio practically every day in an ideal world. So the two ways that you look at it in terms of valuation and then where do you stand in the growth opportunities. One way that you look into valuation is the relative valuation. And when I say relative, we are looking into relative to the market. So on the left side, what you can see is where when you started the portfolio, it was kind of 1.3 times that of market multiple. So market multiple was say around 10 times EV EBITDA. It was our portfolio was 13 times. Even now, it has actually come down slightly. If you go into decimal point, we'll see that. So the point is that we are trying to make the portfolio a little bit less expensive related to the market. At the same time, if you look at the right side of the slide, this is the future revenue growth expectation of FY25, FY21 next year, next calendar year. What is the future sales growth estimate? That is actually close to, actually little more than close to twice that of S&P 500. The point is that we're trying to make sure that the 5% or alpha, net of alpha that we talk about, that gap exists in terms of the fundamental compounding. At the same time, trying to make sure that the valuation part of the portfolio is well under control, so you don't get whipsawed. Now, one thing that is very fair ask that where is S&P trading compared to its own history? Uh, if you look at this, is basically the S&P 500's P next year P, price to earning ratio, and the data is from 1995. If you look at it, last almost 30 years, the current level where S&P is trading is actually at a very high level. I've not seen many times. But at the same time, our point is that if you just go down a little in the market cap spectrum, which is specifically mid cap, and S&P 400 is the mid cap index in the US. So if you look at where that is trading at actually close to the median, close to it historical 25-year median, 30-year median. And that is exactly where we see most of the opportunities kind of emerging. Now, having said that, I mean, we understand why there's a disconnect between where the S&P 500 is trading versus where the S&P 400 mid cap is trading, because the large cap index, especially the large ones like the Max 7 or these companies, they are actually delivering earnings, whereas most of the companies in the index, they are actually not delivering earnings. And as a result, you typically see money flowing through those kind of stocks and making them expensive, maybe for right reason. But the point is that what I think is that once there is a reset, even the relatively cyclical companies which are kind of out of favor but high quality companies, that might be very attractive. So we are kind of digging through those kind of opportunities. If you look at our portfolio composition, uh, the two bar charts here, you can see that the GCP portfolio is actually much more in the mid to large cap in that cohort, In fact, the 250 this the $250 billion or above market cap. If you look at S&P 500, the exposure of these mega caps is around 55%. Right. So if you take S&P 500, 55% of its portfolio allocation is from the mega caps which are having market cap of greater than $250 billion. If you look at our portfolio, it is much lower than that. In fact, 70% of the portfolio or more than that is in the little bit mid to large cap. And exactly that is, the valuation gap that I showed here. That is what we are targeting to exploit. And that's where we stand. I mean, as I said, there are definitely pockets of froth, if I can say it that way. But at the same time, there are good opportunities that are emerging that we are trying to, kind of look at, and when time comes, we will jump into it.
Sure. Thanks, Arindam. That helps. That was pretty crisp and clear. Uh, there are a few questions from investors which I would like to take at this juncture. I think uh, some of them do fit in with the thing which we are doing here. So one initial question is, at this juncture, if an investor is entering into the portfolio, uh, what do you think he should have as a IRR in his mind, as far as the portfolio is concerned? How much can he make? What do you as an investment team think? And also, if you can throw a bit light on the churn rate, what it is likely to be?
Look, the churn of the portfolio has always been within 20 to 25% annual churn. In a rolling 3 to 5 year basis, I think that is going to be the churn rate. That is not going to change. In terms of IRR, again, absolute IRRs are very hard to say. The fundamental compounding of these companies are going to be somewhere between, or I should say, the portfolio should be somewhere between, say, 13 to 16%, which is a number between that. What in terms of IRR on a relative basis, as I mentioned, we're looking for a net outperformance of around 3 to 5 points, because it is a long portfolio. We never know where the market will go. So in near term, but broadly in a longer term, the portfolio should compound with the underlying fundamentals. So it should be around mid-teens.
Noted. And if you can just throw some bit of light on the research process, more so as investors think that Marcellus is based out of India. How do you do research for companies which have their footprints across the globe?
Right. Jaibi, you want to take it?
Sure. So if we had been sitting here in 2019 and trying to do this, it would have been much harder, if not impossible. One thing which overchanged was it reset the comfort that people have with digital communication. It also meant that a lot of expert networks grew in the US. So these have been enablers. We obviously supplement it with travel to different end markets, whether Asia or in the developed world. But the core thing which helps us get insights into companies beyond what's in their annual reports or earnings transcripts or presentation is access to these expert networks, access to a primary contact through digital means, overlaid with travel to these markets. A few years back, these sort of digital connects, these expert networks, wouldn't have been as effective as they are today. Apart from that, we've built a good team, we've built a disciplined research process, we've built effective frameworks which we keep retesting. All of that helps, but without that key digital enabler, it wouldn't have been possible. Anything you'd want to add there?
No, I mean, I think you covered it well. I mean, the primary data research, I mean, which Marcellus is known for, that is uncompromised in this product as well. For every company that we're looking at, we are typically probably doing at least 20, going through at least 25 to 30 interactions. on an average, to make sure that you understand the ecosystem really well. I mean, the process is very simple. Either we understand a company or we don't. If we don't, then we just leave it.
Right. And another question from one of our investors is, how do you think the portfolio is placed in a Trumpian world? Now that the gentleman is in chair, how do you think his policies or our portfolio will react to that scenario?
Yeah. So Trumpian world. What is, look, I mean, there are two ways to look at it. I mean, we don't have too many precedents here. So when Trump came in 2016 November to say 2019, then COVID happened. So the initial reaction was definitely knee jerk, right? I mean, we saw this value rally, which similar kind of things even we saw this time also. But eventually, it broadly came down to the earnings growth, the typical things that you look for: high quality earnings growth. The companies that delivered those, they did very well during the 17, 18, 19 period. That didn't, they actually, the initial excitement actually fizzled out, right? So I don't think that is going to change by any means. In fact, what we are more kind of, as I said, we are looking at several markets, in markets which are close to their cyclical bottoms, right? So, for example, some of the consumer end markets, some of the industrial end markets, they are close to the cyclical bottom. And if there is some kind of policy push around those things, then you might see the excitement a little bit more exuberant than otherwise. But you need the fundamental driver to be in place. Otherwise, uh, you know, Trump or no Trump, it probably doesn't make much of a difference, especially in terms of our, the process. Just to give an idea, since Trump was elected, I mean, this month, basically, November month till date, we're actually at par with, or maybe slightly better than the market. So we have not seen, the portfolio has been holding up pretty well.
Okay, okay, well understood. There are a couple of questions on NVIDIA, and one of them I would read out verbatim. That are you likely to miss the bus again on NVIDIA, because you might not be acknowledging how strong and sustainable its competitive advantage is and how large its TAM is. Surely the excellent companies that are buying NVIDIA's GPUs know what they are doing. Uh, Interesting question for an interesting firm. Jaiveer?
Look, we don't really worry about NVIDIA's competitive moat. That is something we were confident of even 2 years back. If anything, that confidence has grown just because NVIDIA is a company which is they're not they're not at all laid back. They see this opportunity. They've seen this opportunity grow, and they've reinvested heavily behind it. They've increased the cadence of their product launches. They've made sure that nobody else really has any chance of taking share away from them. And so that competitive point of view, we're completely on board with. On the TAM question, right? So NVIDIA estimates for next year put them at somewhere north of $165 billion of revenue next year. Right? If you assume most of that is data center, and you assume roughly 50% of total data center spend going to, roughly 40% of total data center spend going to NVIDIA, because there's also things like structures, cooling, power transformers, a whole host of other things that go into building a data center. That's a very large capex number, and a lot of the companies which are putting this capex, they are talking of it in terms of, it's I'm trying to recollect the exact phrase. It's better to be to spend and be wrong than not spend and be wrong. So that's the way they're framing it, and nobody's The only one who's somewhat talking about ROI is ironically Microsoft, and they're framing it as, "Look, we're building the data centers. If we don't see the demand come through, we'll stop." Right, so we're not seeing from the people actually spending the money, we're not seeing the sorts of arguments we usually see behind capex surges from the same players. So I'd be the first to say, quite possible we could be wrong, and this will hurt us again next year. If that happens, I'm sure Arindam will be yelling at me again. But at this point in time, given where expectations are, we're seeing the balance of probabilities to be somewhat in our favor. Because remember, for the stock to do well next year, the market needs to have a lot of confidence on 2026 growth, that on calendar 26 growth, that on this reset base next year, there will be another 20-30% growth delivery. That's a confidence we don't have right now. But yeah, we could be wrong.
Noted, Jabir. Thanks. Another question is more on the construct of the portfolio. Do we intend to move beyond US and European geographies, and whether we are open to investing in some niche innovative US ETFs as and when they keep coming, or we intend to stick to stocks?
So about other geographies, we are probably okay with where we stand here now, because the geographies around some of the Asian countries like China or Japan, I mean, I don't think we have the necessary capabilities to do that. And in developed markets, I mean, Japan is the only one that is not doing, and you can say Australia is another one. But again, we have looked into those markets before, but we found opportunities here and there, but not that deep. So probably I'm not going to explore that. On the emerging market side, again, we see a huge growth in different countries, but how much of that translates into stock return, that is always questionable, and probably we're living in the best emerging market practically in India. So from that sense, we really do not see at this point of time, unless we build our capability, etc., to go beyond what we're doing now. Secondly, on the ETF side, we do keep tab, especially if we. I mean, we have never done it yet, but we do look at it. I mean, if it makes sense, for example, I mean, if it is hard to take a stock call, we might venture into it, but we have never done it so far. But it is something that is open to us.
Sure. And related to this is the portfolio split between US and non-US, and whether it is open to change. If yes, to what extent?
Yes, I mean, look, it is a bottom-up portfolio. It's a coincidence that the criteria that you're looking for, I mean, we get mostly the US stocks, so it is 75% or 80% is listed in the US. It's an outcome. It is not how the inputs are designed to be, right? So if the inputs are likely to remain same, I mean, we'll be doing tweaks here and there, but unless the underlying fundamentals of certain non-US geographies we're investing, that changes significantly, so the outcome doesn't change as well. But if it changes, then the outcome will also change.
Okay. And I think there's a clubbing of two questions which I can do here, but both of them point to the same direction. That while last 2 years have been good, markets have moved up. How do we ensure we do not end up, buying high valued stocks? In such cases, if there are no opportunities, would we want to take cash calls here? So basically, how do we intend to deal with drawdowns also, which it can come in future?
Cash calls are very hard to take, and I'm not expert in that. What we are typically recommending is that if you feel the market is pricey and you are you're over allocated to this geography, then probably do it in a staggered way. So you have a target portfolio allocation for certain geography or diversification aspect, right? So do it in a staggered way if that is possible. Uh, in terms of valuation, as I said, the valuation we are typically we're taking it. It is a two-pronged approach. One is that portfolio level, where do you stand on relative to the market. So that takes care of um, a relative drawdown part. So if the market is going down, we also go down, but maybe hopefully little lower than the market. Absolute valuation is little harder to do because none of us really know what is the cost of equity at any point of time. So it becomes a very futile exercise to do. Um, Again, we have different valuation guardrails around specific companies, around the portfolio, etc. We make sure that we are not going beyond that. We keep on trimming stocks. If we see that, in fact, one of our favorite long-term holding was Costco. We sold it actually when I'm not comfortable with the valuation, despite liking the company, and we still like the company a lot. So valuation discipline is kind of baked into the process. Um, we try to make sure that you're not getting behaviorally carried away at any point of time. So, I mean, again, on a relative standpoint, I can say that we are fairly comfortable in the drawdown side of it. Absolute, it is genuinely difficult to predict how it would look like. But given the quality angle of the portfolio, in any drawdown, I think these are kind of good buying opportunities for many of the stocks.
Okay, okay. And I think one final question here is, while of course US markets are there, but at the moment India seems to be the center of attraction. So should we actually be looking outwards? And if yes, what is the proportion you suggest we should be looking at?
Yeah, absolutely. I mean, look, India's center of attraction. I think the economic India is going to outgrow most of the large economies. I mean, that there's I think no doubt about that. But here we're talking about more from the diversification aspect because when you're looking at diversification, you're basically thinking about the risks that are unknown to us, and you're trying to find out markets which are not so correlated but can give you similar or maybe at times better returns. And that is where the entire concept of investing in US or investing global comes in. So from that standpoint, our view is unchanged. I mean, it really depends on your liability, etc., what you are looking at, what you stand now. But typically, for resident Indians, we typically say that 70-30, 70% domestic, 30% international equities. That's a good exposure. Uh, I think that still holds true.
Sure. I think one final question in terms of basic ticket size and all, I'll take that. This is a GIFT City based PMS, and the minimum ticket size there we take is 1.5 lakh USD. The ticket size is lower at 25,000 USD for accredited investors. And if so, an accredited investor will be one who qualifies either of the criteria. One is that you have an annual income of 2 lakh USD, or your net worth is 1 million USD, out of which half should come from financial assets. I will get these details sent to you separately also, sir. I think this is all in terms of questions we have for today. Arindam, Jaiveer, any closing remarks from your side?
No, I mean, just thank you for trusting us, and yeah, I mean, if can invest it, and thanks, guys.
Sure.
Yes,
I see Saurav is back. Saurav, any closing comments from your end?
No, I think I just wanted to say congratulations again to the team. I've seen how hard they work. This is one of the more remarkable team builds I've seen in my investment career. And those who are listening, those who are interested, I would strongly recommend think seriously about investing in this. You need diversification. I need diversification. There's no point loading up all your chips into one country however strong that economy might be. Diversification is one of the simplest ways to get a free lunch in finance, and that's those skyscrapers staring at you on the screen. Is a free lunch staring at you. I have tucked into that lunch. I intend to tuck in some more. I think ideally for someone at my age, my stage of life, half my money should be in North American equities, and half should be in Indian equities. I'm at the moment 70, 30, 70 India, 30 North America. I'm going to try to redress that balance and move to a 50-50 construct because that's how I intend to optimize the diversification benefits of investing in the two best stock markets in the world, which is the United States and India. Thank you very much, everybody, for joining us. Thank you.
Thank you. Thanks all for joining in. Have a great evening.
Thank you.